Thanks so much for attending. Today, we're going to address an issue that's been presented to the firm quite a bit in the last maybe year and a half, and that's the means and tax impact of leaving the country. We're going to go through a pretty involved agenda, which addresses the two sides of expatriation. The first side of expatriation is the income tax side, and the second side is the estate tax side. By the way, very few even tax practitioners are aware of the estate tax side. So it's kind of, we have a lot of CPAs, a few tax lawyers on the line. We have several financial planners on the line. This webinar will address a lot of the principal issues that you're going to come across in terms of if someone may be running into an expatriation without knowing it, it will raise the issue so that you're aware of some of the exposures. And obviously, ask any questions you like. We're going to try to hit some of these main issues so that if something comes up in your practice, at least you can make the client aware. We're going to hit this expatriation. We're going to, in terms of the general idea, that law has actually gone through several phases of development. It's an interesting area. We'll work through this income tax side, then we'll talk about the state tax side, and then we'll go through, if we have time, I'm sure we'll have a few minutes, but we'll go through what we refer to as the expatriation of assets. So expatriation is people. We'll talk about how tax expatriation actually involves people who aren't citizens at all. It also encompasses people just living here. And then we'll go through the expatriation potentially of assets and how that has a tax impact. The expatriation regime affects U.S. citizens, which obviously that's fairly straightforward, who give up their citizenship. And it also affects non-citizens, which is what we see in practice. The reality is that very few U.S. citizens, until quite recently, really are disposed to saying, okay, I'm going to surrender my passport. I'm going to go through the ICE process of giving up my U.S. citizenship, because there's so many advantages historically associated with you being a U.S. citizen. There's a lot of pride, there's nationality, there's a lot that goes along with it. But where we see it come up really frequently is you have people who are resident here. So the tax code says it's not just for citizens, it's for people who are resident here with a green card. One thing to keep in mind on this regime is it's green card based. So if you have a client or you're a non-citizen living here and you don't have a green card, this regime, this expatriation taxation doesn't apply to you. That being said, almost no one, even with a green card, pays attention to this. The problem is, when someone with a green card comes into the States and stays here for 8 or 15 years, you fall into this regime. And the real exposure that we found is, for instance, if you have an Argentinian who comes to the States on a green card, a wealthy person gets trapped in the expatriation regime. The taxation applies to the assets all over the earth. So even if, like, for instance, the individual comes, the Argentinian woman comes in, she has 8 or 10 commercial buildings in Florida. It's a lot of assets, but let's say she's got 500 of them in South America. the shocking part of this to the client is that this regime now applies to their assets worldwide. You can imagine, the shock and the fact that, probably half the people involved with this that I've come across just kind of run away. It's outrageous, the attacks that can be associated with this expatriation. So it applies to a green card, a resident who's here 8 of 15 years on the green card. There was an initial regime called 877, and then we moved into 877A, and I think we get into that here. So citizens and non-citizens who permanently leave the U.S., citizens who give up the passport, non-citizens who give up the green card. So that's the general basis of how it works. There's an exit tax, which is an income tax, and then there's an estate tax side of it as well, which is very, very hard to follow. That's why I'm trying to give you some historical background, because some of this stuff becomes very difficult to understand, because what we try to do is we try to make logic of it to understand it. The only way to really make logic of a lot of this stuff that came out of the Clinton administration in the mid-90s really is to understand some of the historical background. So the exit tax in its current format is a deemed sale of assets worldwide. And the inheritance tax is it's a gift or estate tax that the recipient receives. So on broad brush here, just so you can keep it in mind as we work through some of the slides, the exit tax is a deemed sale of everything on earth that the expatriate has, and the inheritance tax taxes the recipient. So if the person exits and says, I've got kids in the States, I want to give them back assets, the kid's taxed. It's an inhibition to send back assets back into the States. And so what I wanted to do was talk about the transition. Let's see here. The residency start date is pretty straightforward. For income tax purposes, you have this idea of being a resident here under substantial presence, which is more than half a year. It's an averaging over 3 years. And for the estate tax, it's the same idea. Estate and income tax are still over the last 80 years is still viewed completely different in terms of residency. It's the residency that triggers the worldwide coverage. So for income tax, if you're here for more than half the year, or you're here for several years, and an averaging occurs whereby you get caught into substantial presence, you're taxed on the income worldwide by the IRS. And with estate, you can be here 2 days, but if you're here and you intend to stay, your whole estate worldwide is taxed by the IRS if you die. And then the residency termination for a non-citizen, obviously for a citizen that's giving up the passport, for a non-resident, it's when you give up the green card. So on a historical basis, what happened was we have a rule in the States that if you're a non-resident, non-citizen, you're completely a foreign individual, and you want to invest in stocks and bonds. Years ago, I believe it was in the early 50s, legislation was passed whereby if you're not connected, if you're not living here and not a citizen, you can trade stocks and bonds, intangible assets at no tax. You absolutely pay no capital gains tax. It's amazing how few people still follow that. So that goes on today. It's totally unchanged. You can buy and sell stocks at no capital gains. You may have tax in your home country, but most countries don't have a capital gains tax. That's really an American thing, or it's very, very small, the rate. way that the expatriation tax started was in the mid-90s under the Clinton administration. The legislation picked up on it, on a means by which to reconcile the budget. So what would happen would be that there was a strategy made by people who wanted to invest in a business in the United States. In light of the fact that you can buy and sell stock at no capital gains if you're foreign, what would happen would be someone from, let's say, England came to the States, says, I want to start a business. And I operate in this type of business in the UK or worldwide or whatever I'm doing. I'm going to go ahead and start one in the US. So I start this plumbing distribution operation, and I'm going to build it up, and it's going to be huge. And they spend some time building it up. They stay here quite a few years. They probably get a green card. And so before this legislation in the mid-90s, then they would leave the country. They would become a non-citizen, non-resident for income tax purposes and estate tax. But it was really the income tax that they were interested in. So now what? Now what? They can sell their stock in a U.S. entity at no tax. So people would invest in the country. They would build up the business. They would say, well, what I'm going to do now is I'm going to leave, become a non-citizen, non-resident. I'm going to sell the stock. I'm going to sell the stock out to a huge buyer, and there's no tax. So in the mid-90s, the legislature was the U.S. legislature, Senate and House, were looking for a means by which to reconcile the budget, and saw that this practice was going on. Obviously, there's gaming going on there, but it also created a lot of investment in the U.S. So there are probably two sides to that story. And said, we're going to invoke a taint. So if in fact you build up a business and you give up the green card, we're going to taint you for 10 years. So for 10 years, and so it was up to 2008, right? Did this law apply? So for 10 years, you can't sell. If you sell within the 10 years, you're going to be taxed. After the 10 years, you're free to sell. But it was hard because there was a buildup of the business. And so the idea was then, okay, now that we built it up, we want to sell it. Now we had to plan for the 10 years. And I think people kind of did plan. I think there was quite a bit of planning that went on. I think there was, we'll get into some of this, the idea of not becoming a covered expatriate. So that 8-year period, there was a giving up of the green card before the 8 years. You know, the green card's for employment. You can still manage a business in the U.S. without a green card. But the green cards would link you back to the exit tax. So there was a lot that went on. There was still a lot of investment like that in the U.S. until the law changed in 2008. So what we did, there's your 10-year taint, this slide. It goes through more or less some technicalities of the law. There were two regimes. It's very involved, actually. The reason I'm not going to spend the whole time on it is because there aren't that many people anymore. We've actually had a couple, but there are not that many people who are going to get covered by that 2008 rule. We're getting into 22 now. And so the likelihood of you crossing back into 2008 is unlikely. And so there were two regimes, and depending on if you're here more than 30 days in a particular year, but it's probably not that relevant, except to understand the historical side of the law. And what happened was the new law was layered on top of this existing 877, which had standards that were kept. Certain standards for becoming a covered expatriate were kept. So you have a 5-year average income, which is about $180,000. Obviously, if you have a wealthy individual, they're always going to exceed the income issue, or a net, or at least $2 million in net worth, or they fail to certify the process under the tax law, which is just, that's just kind of stupid. What happens is, if in fact they were exempt but didn't see a tax lawyer or a tax specialist on expatriation, and they fail to certify that to the IRS, they're not exempt, so they get trapped in this exit tax. So in 2008, this is more on 877, which is the 10-year taint. I want to kind of get into how the whole thing works. Like I had mentioned, it's a worldwide taxation. The taint is the 10-year taint, and it has to do with, it also covers, it does have an aspect of it dealing with gift and estate tax law, where it treats you as US for the 10 years. So we get into now 877A, which is the layered law that currently applies on top of 877, which where Congress said, you know what, this isn't really working with this taint. As you can imagine, I mean, someone leaves the country and there's a 10-year taint. They could be in, Seychelles Islands. They can't track the people. I think it's very hard for them to deal with every stock sale that's involved with someone who's out of the country. It wasn't working. What we're going to do is we're going to require the tax be paid at the time of exit. So if you give up the passport or the green card, if you had the green card for 8 of the last 15 years, there's a mark-to-market tax that occurs under 877A, which is the current law. The mark-to-market occurs based on an idea that you sold everything. Not that you sold everything in the US, but that you sold everything on Earth. Which is, that's the part that you have to take a little pause. You might want to have a little whiskey on the table or whatever when the client's in front of you. Because this same Argentinian says, okay, I understand, I'll get mark to market on my 3 buildings here. I'll get a step up in basis. I can deal with that. No. It's a mark to market on everything you own on Earth. So capital gains tax accrues to the 2 billion offshore or whatever the number is. It's a complete debacle. And then the inheritance tax is I had mentioned is the same idea, but the idea is once you're out, the inheritance tax says there are certain benefits associated with being a non-resident non-citizen. Once you left, you're a non-resident non-citizen, but we're not going to let you benefit by the idea that, non-resident non-citizen can sell stock and bonds tax-free. They can give gifts of non-US assets tax-free, and they can give gifts of US situs and tangibles tax-free. You can't do that. You can't go out and then say, okay, I'm going to move back assets with a high basis back into the country to my kids. No, what we're going to do is we've lost you at this point. We're going to tax the kid. The kid's got to pay the gift tax or the inheritance tax on the stuff that comes back in. So basically stuff doesn't come back in, which is that good policy-wise or bad? It's got arguments on both sides, because what happens is people just don't send it back in, pay the 40% tax. It just doesn't happen. Now, we'll get into some of the foreign trust issues. There is a way to deal with it with a foreign trust, but it has its drawbacks as well. Same test. The 877 was not completely superseded by 877A. So 877A layered on top of it. And the idea is, are you a covered expatriate? Are you even covered by the rule? So besides this idea that you gave up your green card and were here for 8 of the last 15 years, do you qualify, so to speak? Are you trapped? as an expatriate, and it's the same $2 million. Are you worth $2 million? So one strategy, obviously, is to get under $2 million, but it's only $180,000 income tax liability averaged over 5 years. It's any of these. If you're trapped by any of these, you're going to have this exit tax. Or did you fail to certify? So that's the blanket. If you completely go out without any planning or compliance, it doesn't matter what your net worth or your income is. This goes through some of the steps on the deemed sale. So it's an unintended sale of assets. The valuation issue is they take it to the estate of the individual, and the estate of a resident is everything they have on earth. The day before expatriation, there is an increase in basis for that occurs when you pay the tax, which is, I mean, seems pretty obvious, but so the basis goes up. Remember, when you leave, you can't send. This happens. That's why I mentioned it. You can't send assets back into the kids without paying that 40% tax, because you already have this basis adjustment. Oh, a good point here is that it's not meant to trap people with I think it's 780 or something like that, 765. It's about $780,000 in assets. So fortunately, there is an exemption. It's not the net worth amount. It's actually, it's about $780,000 of gain. So it's quite a bit of gain. I thought that was a great safe harbor, because it does exclude the mass of people who would violate and trigger the exit tax who aren't very wealthy, because gain is significant. Or if you're wealthy and you hardly have any gain, which is unlikely, but it's at about 780,000, you will not get trapped because there's no gain. And if you have a massive gain, there are deferral rules where you can apply to the IRS to pay it off over time. So that's the mark to market. If you have a question, just tell me know through the Zoom. The inheritance tax is, and we're on time. That's good. The inheritance tax is something that's hard to understand without the background that we went through. So the inheritance tax is the idea that you're leaving the country and that the country is going to impose this penalty on you to the extent that you want to move assets back into the country. Whether that's good or bad, it's hard to say. From my perspective, everyone's going to have their own opinion, but this is the current law. So if you have an expat, either a citizen or long-term green card holder, and the kids are in the States, you have to do some planning, because you basically can't send the assets back in, or the kid has to pay 40% on the value of the asset. It's in addition to the mark to market. So you pay your mark to market going out, and the assets are trapped out. What's a little unfair, and it says here on the slide, it's the recipient that pays, because the expat's gone. The IRS doesn't want to deal with the expat. What's a little unfair about, I find, on the inheritance tax, it is obviously a little odd, the tax, but when you leave the country, you pay the mark to market, and you become non-citizen, non-resident. If you were just a green card holder, it's a little rough, because the inheritance tax doesn't expire, and it applies to all the assets you acquire offshore after the fact. So what the service is saying is, you don't benefit as a non-resident, because a non-resident, non-citizen can gift, and obviously buy and sell, but can gift, per the inheritance tax, whatever you want back into the States if you're not subject to this inheritance tax, if it's offshore. Any foreign asset can be gifted into the States. The transferee has to disclose it, but there's no tax. So they're saying if you decide to leave, and I'm not talking about citizens, it would somewhat be understandable with citizens, but if you're a green card holder and you decide to leave, there's no expiration of this. So 25 years in the future, if you want to give back assets into the States, can't do it. You got the 40% tax on assets you didn't have when you left. It's a little out there, I think. So it's an estate gift. It's not related to the income side, which is the mark-to-market expatriation tax, 40% of the value, and there's no step up. Your gift, the transferee gets your lower basis. There's no step up in basis, and there's no step up at death at all. Plus, there's a 40% tax. So what happens is it kind of eliminates the ability to get money back into the States. The rules are fairly complicated with foreign trusts, like most things with foreign trusts. If it's a U.S. beneficiary to the foreign trust, that there's only a tax when the U.S. beneficiary receives a distribution. There's no grantor trust issue because this is a totally different regime. This is simply assets going back into the state. In other words, sometimes with grantor trust, you just ignore the trust. And so this 2801 ratio, it gets a little beyond our webinar, but you're going to have assets that are subject to the tax and assets that are not subject to the tax. There are exceptions to the tax. In other words, gifts that would have been taxed are not taxed twice. So if an individual has U.S. assets and wants to give them to somebody in the U.S., if it's a tangible asset like a piece of real estate, there is gift tax. There is gift tax. I mean, that's a shocker to a lot of people who don't plan before they purchase real estate in the U.S. We see that pretty much every day. We're trying to get, for instance, a huge partial out of the country now, and it's become quite the challenge. But if it's taxed, it's not subject to this so-called inheritance tax, which is applicable to the expatriate. And that's consistent with other gifts. As the planners on the line know, the recipient receives the basis of the transferor. And has nothing to do with the fact, a lot of people say, well, if I already paid the mark-to-market, it doesn't matter if you paid the mark-to-market. You did get the increase in basis, but this stuff applies anyway. It's not, you don't get out of it by paying the mark-to-market. And there's a 40% tax when it comes in, even if you pay the mark-to-market, because the theory is you got to step up in basis. The problem with the theory is it can apply to it does apply to all your assets that have nothing to do with that were not subject to the mark-to-market tax. This just goes back to some of the basic definitions. We've already covered who is a covered expatriate. The reason we had this slide, we had included this slide, was the U.S. recipient. It's not just a person, it's any domestic trust, any kind of domestic partnership, partner, etc. It's pretty much anybody who gets an asset from a prior expatriate or a covered expatriate, let's say, and it never expires. And I had noted there are some exceptions to for taxable gifts. There's you can give to charities. One interesting planning move is the spouse. So transfers to the spouse are not subject to the inheritance tax. One thing we've found over the years is one spouse, maybe the spouse who owns the business, comes in, gets the green card, and is here for the 8 years and gets trapped. Whereas the other spouse either doesn't need a green card or comes for planning and we catch it at 6 years, something like that. So you can actually avoid expatriate status for the spouse. And there's often some planning you can do there because spousal transfers are exempt. And I had mentioned that on the slide here, it goes through the difference between domicile for estate, which applies to the inheritance tax, and domicile for income tax, totally different standard. This goes back to who's a covered beneficiary, and basically it's anyone who receives the gifts in the U.S. from an expatriate. And so it has a line on foreign trusts until no inheritance tax until the beneficiary in the U.S. receives the money or the asset. The calculation is somewhat interesting. It's its own regime. Whereas, for instance, by the way, it's 16,000 now. We didn't update the slide from, I think it was in December. So the tax is calculated from the perspective of the recipient. So whereas normally we would say to clients, go ahead and give gifts at $16,000, there's not even a filing requirement. You don't eat into your exemption or anything. Pretty much the whole world is aware of the $16,000 exemption. But you get the $16,000 exemption for each person you give the gift to. So grandma's got 20 grandkids, each one. It's a freebie. You can get out the 300 grand because you do it $15,000 a grandkid. No problem. This one's a little different. The recipient gets every year. The recipient gets 16,000. So if the recipient gets gifts from a number of different grantors, you only get the 15,000. So it's 40% on the bulk, less 16,000. Sorry. There are some strategies associated with mitigating the tax, but the inheritance tax is very hard to avoid. I would tell you, in terms of the generalities, we have some items on here, but these items typically are strategies to avoid becoming a covered expatriate. If you're not a covered expatriate, you're not subject to the exit tax or the inheritance tax. So these strategies on this slide have to do with avoiding status as a covered expatriate. And on the net worth, you can get down below $2 million, but you still have the income issue. You can do gifts through the expatriate trust. That's the same idea. You give gifts to get yourself under the $2 million threshold. You can do what we call non-resident alien domicile planning, which works pretty well, actually. So if you're a green card holder and you've been here the 8 years, you can hang on to the green card and still pay tax on worldwide income, right? And if you die, you're subject to estate tax on worldwide assets unless there's a treaty. Well, what you can do if you're going to expatriate is you can move out of the States and make clear that you don't intend you have no present intention to return, right? You become a non-domiciliary for estate tax purposes. You have the green card, so you're still a U.S. income tax payer on worldwide income. But you're not a U.S. estate and gift taxpayer, which entitles you to give assets away for completely free of U.S. gift tax in terms of foreign assets. And really where we see this come up is where people have a bulk of foreign assets and light U.S. assets. And so what we do is we create a trust, a foreign trust, or some similar vehicle where they can get their net worth down, or they can give away assets offshore that have a high built-in gain that they're going to be hit with upon expatriation. totally legal. So you get rid of the assets by not living in the US. And then when you expatriate, you give up the green card. The mark to market is mild. And then the inheritance tax applies, but hopefully you've planned it such that you can take care of your family that's in the US. Does that make sense? So you change your status for estate and gift tax purposes to foreign. Foreign people don't pay estate and gift tax on foreign assets. You get rid of the foreign assets. You bring down the basis for the mark-to-market tax. Or you could, if you get under 2 million, you completely eliminate it. You become, you're not a covered expatriate, and you do some planning like that. This goes through the covered covered beneficiary. I'm sorry. This goes through the inheritance covered beneficiary. This really doesn't say much, this slide. I like to keep it as practical as I can. It's got some definitions, etc. The idea on the covered beneficiary is if you understand how the expatriation works, you're then going to say, okay, I'm going to somehow benefit my US people through maybe a domestic trust or whatever I'm doing before expatriation, beneficially 3 years before. There is a 3-year pullback. Because when I get out of the country, I'm not going to be able to get assets back to these kids who decided to stay in the US. That's why we say gifting to a non-US recipient is a good idea. No kidding, because they get otherwise the kids in the US get hit with the 40%. So there's some planning pre-exit where you may benefit the US kids substantially more, especially with US assets. And you can do some charitable givings mentioned here as well. What we want to do, sometimes we put this at the beginning, sometimes we put this at the end. It's an overview. Let's see, we've got about, I'd say about 8-10 minutes before we take questions, where we've spoken about the exit of people from the US and the mark-to-market tax and the inheritance tax. You also have to keep in mind that there's a tax associated with the exit of assets. That's for US people and to some degree non-US citizens. So it has to do with the transfer of assets to a foreign trust, which has become very popular, but there's a very clear path that you have to take associated with the transfer. I'm going to probably go through the basics pretty quickly in terms of the estate and gift. You now have a huge exemption for residents and citizens of about $12 million for each spouse. So the reality is that only the very, very wealthy will have an estate tax until it goes back down to $5,000 each spouse in 2026. That's adjusted for inflation. Be more, a little bit more. I'm sorry, 5 million. 5 million for each spouse. Be a little more because there was an adjustment. And you get 16,000 a year annual gifts without any reporting. This has to do with the gift tax and how gifts above the 16,000 reduce your credit and how that's tracked. It's determined on the annual basis. The estate tax is determined when you go. It's all your assets above the limit to the extent you haven't used it. Domestic estate tax planning is incredibly effective right now because of this exemption. We can get tremendous amounts of assets outside the U.S. estate. Trusts are, a separate entity. They can be grantor, which means that the actual funder of the trust can get assets out of the estate, yet retain the income tax on that. What that allows for is that the grantor can pay the tax. It's not an additional gift. It doesn't eat away at the unified credit. one thing I tried to hit on when we talked about the expatriation is the difference between the income and the estate taxes. The income tax is worldwide income for domiciliaries who are here more than half the year or under this substantial presence test. And the estate tax has to do with you arrive and you wanted to stay. In that case, if you're here and you want to stay forever, all your assets worldwide will be taxed when you die. There's some exceptions to the income taxation for non-citizens residing here. There's a lot of treaties which will reduce certain taxation. What I had mentioned is if you're a non-citizen, non-resident, non-U.S. person, that's covered by this line. You can sell stocks and bonds free of tax. If you have income here, it's a flat tax. A lot of people don't understand the flat tax issue. If you've got rent and certain interest that's not exempt, there's a 30% flat tax. Foreign trusts are treated as foreign individuals. It's very similar to foreign individuals. And the estate tax is interesting. It's similar. It's a similar regime to the gift, but there's an exception for if you're not here and you're not a citizen, you give away the stocks and bonds without tax. You give them away. But if you die with the stocks and bonds, it's taxed 40%. There's no time to go into the complete taxation of international trusts. But in general, you can view the foreign trust as a foreign individual, very, very similar. But what we were getting at in terms of the expatriation of assets, there's different rules for domestic people as opposed to foreign people. If you're U.S. and you form a foreign trust, we do a lot of foreign trusts, and you have a U.S. beneficiary, either yourself or your kids or your whatever, it's completely disregarded for tax purposes. Several years ago, there were a means by which you could manipulate the foreign trust to be separate income tax wise from yourself. Also, there was a manipulation done by foreign individuals who had a foreign trust who would invest in the United States, where they could play around with the income tax rules. What the 679 does is it says if you're U.S., you're either a resident, a domicile, you're here and you want to stay here, nothing to do with the green card, or you're a citizen, and you form a foreign trust and you're going to fund a foreign trust, it doesn't exist for income tax purposes, right? So you have to be careful because there's section 684, which says if you transfer assets to the foreign trust and it's non-grantor, which means it is regarded, it's not ignored for tax purposes, for income tax purposes, it's a deemed sale. So if you fund the trust, so if someone comes in from Ecuador, they're here and they're wealthy, and they decide to form a foreign trust, but they want it for the kids, right? The kids are not U.S. They're not U.S. and they're not they're beneficiary. They're the only beneficiary. So U.S. person with domicile in the U.S., not a citizen, comes in, forms the trust. This happens quite a bit. Forms a foreign trust for the kids. The kids aren't here. You now don't have a U.S. beneficiary. Deemed sale. When the assets go out to the trust, it's a deemed sale of those assets. Very tricky. It's similar to the expatriation for assets. For U.S. people, what happens is if you have a U.S. beneficiary, you almost always for U.S. people have a U.S. beneficiary for U.S. citizens. If someone comes in, they're not a citizen, and they transfer to a foreign trust, they may not have a U.S. beneficiary. They've got the deemed sale. For U.S. citizens, you almost always have a U.S. beneficiary. So it's disregarded for income tax purposes. There's no deemed sale. The deemed sale occurs at death. So when that grantor dies, there's a deemed sale, and so there's a capital gains tax that's triggered on the gain. But if those assets were inside the estate of the U.S. grantor, the basis went up to fair market value on step up, and there's no gain. So what we found a few times is an error was made where assets went into one of these trusts on the estate tax side as a completed gift. So there's no basis step up. So when the grantor dies, there's this deemed sale of assets and there's a capital gains tax at death. It's really a trap for the unwary. So that will leave us with about 10 minutes left, 10, 11 minutes. Let's see what's left so we can have some questions. Oh, that's it. So as a wrap up, when someone comes into your office, or if you're a non-citizen living here, and you notice that there's a green card issue, someone comes in with a green card, let's try to determine how many years they've been here on a green card, right? And then whether or not they're going to leave. So many people come in, they get the green card, and their intention is not to stay forever. And when they return, they have absolutely no intention of paying tax on their worldwide income. So they want to give up the green card. If they don't give up the green card, they've got the worldwide income tax. This is going to be true with 95% of the green card holders, the wealthy green card holders who are not in a treaty jurisdiction. That means anywhere in South America, most of Asia, Eastern Europe, a lot of European. It's focused on the European countries, the treaties. So if there is no treaty, you've got this issue of deemed sale. So planning really needs to be done. And then on the foreign trust issue, just have to be very careful if we have a non-US person who has beneficiaries outside the country. So if foreign trust is funded, we could trigger that tax because we got no US beneficiary. And that will leave about 9 minutes for questions. If you have any, please let me know. We really appreciate you attending. I hope you enjoyed it. If you would like any of my books on international tax or asset protection, my contact information is at the bottom of the slide. Or if you have any questions at all, just let us know. My email address is there, our office number's there. And we really appreciate you attending.